This video will cover the money supply and the Federal Reserve. Specifically, we'll discuss the functions of money. We'll define two definitions of money. We'll look at the Federal Reserve System and the FOMC, which is the Federal Open Market Committee, which some people argue is the most powerful committee in the world. We'll talk about the Fed funds rate and the Fed funds market, in which the Fed funds rate is the interest rate associated with it, the price of money basically between banks. We'll discuss fractional reserve banking and compute a money multiplier. We'll discuss leverage, compare and contrast banking to shadow banking, traditional banking to shadow banking. And then we'll discuss traditional and non-traditional tools in monetary policy, MP. You recall monetary policy is that the mechanism by which the Fed tries to manipulate interest rates to move the economy closer to potential GDP, smooth out the wrinkles. Then we'll graph the money supply and money demand and we'll graph money supply and money demand and look at the determination of interest rates. Now, moving right along, let's look at the functions of money, and then let's compare it to Bitcoin, because we can learn a little bit more about these kind of abstract concepts of the functions of money if we compare and contrast money, like the dollar, to Bitcoin. So, money functions as a medium of exchange. It's commonly used as an intermediary instrument to avoid the problem of double coincidence of wants. So imagine if I owned a bicycle and I wanted a microwave oven. You know how much trouble it would be for me to try to find somebody who's interested in getting my bicycle, who wants my bicycle, right, and is willing to give up the bicycle for the microwave oven. Really, really hard. So money eliminates that problem associated with the double coincidence of wants. It could take you forever to find somebody who wants to swap something with you. And what it ultimately allows you to do, going back to a previous chapter, is having money allows you to specialize more in the production of something that you're good at doing, rather than spending a good part of your time trying to find somebody to trade with. Money also has a store of value to it. It provides current and future purchasing power. Obviously, current purchasing power, but future. You hold on to it, and if it's relatively stable, which in most cases it is, you'll be able to convert that money into goods and services. It also has a measure of unit of account, which means it measures economic transactions. So it's basically a yardstick for economic transactions. Prices are posted in terms of money, debts are recorded in money, and money allows us for instant comparisons. You can value a car that's worth $40,000 and compare it to the value of a house, for example. How many cars would it take to buy a house, so to speak? Well, by putting everything in the money terms, it's much easier to compare values. Now the question becomes, what about Bitcoin? Now the interesting thing is I teach a lot of investment management, teach lots and lots of sections of investment management over the years. People have asked me, well, is Bitcoin a good investment? And then I often teach a course called Financial Markets and Institutions, which is a lot about this chapter, where we talk about money supply, and the Fed. And students ask me, well, is Bitcoin money? In Bitcoin, the definition kind of has the word currency in it. So Bitcoin is a cryptocurrency that enables payments to be sent directly between parties. Okay? But you're going to need money to be able to get your hands on that cryptocurrency, right? You're going to have to go through an exchange or a broker to get it. The other thing is, cryptocurrency is, it's only valuable to the extent that other people think it's valuable. It's socially acceptable. Also, keep in mind that the value of Bitcoin is quite volatile. So if you look at the price from January of 2017 through about 2018, you will have seen that Bitcoin went up from $975 a coin to $20,000, and then back down to $3,200. And then during the coronavirus in March of 2020, it crashed nearly 50%. So now the question becomes, Well, we know there's three functions of money. How does Bitcoin stack up to those three functions? Well, is it a medium of exchange? Well, the medium of exchange would mean, I could go to Amazon, for example, and start seeing prices in terms of Bitcoin. Not dollars, but Bitcoins. This item will cost, 20 Bitcoins. I don't see it. I go to Walmart, I walk down the aisles. I don't see the tags on the shelves talking about Bitcoins. I see it all denominated in dollars. So the medium of exchange, not so good. What about the store of value? Well, store of value, it's not very good if it gyrates up and down. It's not very stable. In fact, that's what people initially talked about Bitcoin as being a more stable currency than, for example, the dollar or the yen or the euro. And that's really not been the case. I mean, look at the dramatic swings in the value. And then is it a unit account? Not really. For the most part, people are not thinking in terms of Bitcoins and recording things in terms of Bitcoins. Now, obviously, there are some people that go deep into this, but by and large, Bitcoin is not used that extensively. So it kind of fails the test of money, the functions of money. And then the question is, okay, it's not money. It's not really money. Although people seem to really want it to be money, and it sort of acts like money. Then the question is it an investment? Well, yeah, it is kind of an investment. It's more or less a speculative investment. If you're buying it at one day at $975 a coin, and then it goes up to 200 or 20,000 and down to 3,200, that's kind of acting like a speculative investment to me. And so, yeah, I would consider it a speculative investment more so than money. Moving right along, let's talk about the various definitions of the money supply. Believe it or not, there are various definitions, working definitions of the money supply. It's used by the central bank itself, the Federal Reserve, and economists. The first definition is a narrow definition of money, and it's the most liquid form of money. It's composed of currency in circulation, in other words, what's in your pocket and what's in cash registers. It's composed of checking accounts, because you can take a checking account and convert that pretty quickly into dollars in the currency. And they're often called demand deposits, because you can go at demand and pull that money out of a bank, and the bank is required to give you your money on demand. That's why they're called demand deposits. So it's very liquid. Then there's traveler's checks, and we're not going to worry about traveler's checks. They're not used very much anymore, and it's a very small amount of the money supply. Then there's a form called M2. A definition of M2 money supply is that it equals M1, the narrow measure, the most liquid, plus it has less liquid accounts. One is a savings deposit, right? Deposit accounts, and those accounts are technically less liquid, although you can go to a bank nowadays and get your money out of a savings deposit pretty quickly. They don't have to give you your money back immediately. A bank does not have to do that. If you read the fine print, they can delay payment a few days. So that's why they're not called demand deposits. They're savings deposits, and the interest rate's usually a little higher in those. You notice checking accounts, if you notice your checking account, generally pays very, very low amounts, if any, where a savings deposit will pay a little more. Then there's also retail money market funds. That's not part of the banking system per se. We'll talk about those in a little bit, because those are the shadow banking system. They were probably some of the first shadow banks that existed in this country, and they started out in the early 70s for the most part. And I'll talk about those when I get into various balance sheets in a few minutes. We can compare and contrast what retail money market mutual funds are. But the word retail just means it's for individuals like you and I, as opposed to institutional money market funds. In other words, we're making deposits. People like you and I make deposits in these money market mutual funds, and we earn a small rate of return, but better than what you'd get out of a checking account typically, and what you'd get out of a savings account. Then the final form that's in in the definition of M2 is small time deposits. Small means it's under 100,000, and time deposits are like CDs, certificates of deposit, where you basically deposit your money in a bank with the agreement that you'll keep your money in there for 3 months or 6 months or a year, whatever the term specified is. And the bank will actually penalize you if you try to pull your money out early. You can get your money out early. It may take you a few days to get your money, but you'll have to pay a penalty to get it. Those are time deposits or CDs. By the way, there's a third measure of money, and that's called M3. And M3 would include M2 plus institutional money market funds and large time deposits. But we're not interested in M3. We're interested in M1 and M2 because it's talked about a lot by the Fed and various economists. It's not as useful anymore. So the exact definitions of M1 and M2 are, they're there, but they're kind of blurry in reality. So we can define them carefully on paper, but when it comes to actually measuring them in reality, it's hard. Here's why. For example, you may deposit your money into a checking account, and the bank will keep that money in a checking account during the day. So if you want to access it, you can. But what they'll do is they'll sweep it into another account that pays a higher rate of return overnight. And they do that to avoid various regulations around checking deposits and reserve requirements and things like that. And so what is it? Is it part of M1 or M2? Well, it depends. During the day, it seems to be part of M1, and during the night, it seems to be part of M2. So there's no clear-cut answer to that. So the definitions in reality are quite blurred, is the point that I'm trying to make in this area. Okay, now what I want to do is let me talk a little bit about retail money market mutual funds. They're the first shadow banks. And in doing so, I'll introduce the concepts of balance sheets, and we'll look at the balance sheet of a shadow bank. We'll look at even at an individual's balance sheet. We'll look at the Federal Reserve's balance sheet, and then we'll look at what does a shadow bank today look like on average in terms of its balance sheet. And then we'll get a better understanding of the type of business it's in. So let me move over to pencil and paper now, because like I said, I'm going to be doing balance sheets. It doesn't work very well in a PowerPoint presentation. Okay, let's talk about retail money market mutual funds. And before I actually jump into that, let's look at the balance sheet of an individual so we're comfortable with what a balance sheet represents. So here we have an individual, and an individual has assets, has liabilities, and has equity, which is sometimes called net worth. Assets equal liabilities plus equity. And it's this side of the balance sheet that funds this side. And you'll see what I mean by that in a second. And the other thing is to keep in mind that a balance sheet balances. So this side equals this side. And so the totals have to add up. So let's look at just a hypothetical person. Let's say a person has cash. It could be literally cash in their pocket or cash in a checking account. It's an asset to an individual. So remember, assets are over here. They may own an auto, a car. Let's say it's worth $1,000. And they may own a house. And let's just say it's worth $10,000. The entire asset side of this individual is worth $11,100 as is, at least in terms of assets. Now, this individual may not have paid for the house 100% themselves, so they may have a mortgage at this point. And that's a liability. Let's say it's $5,000. So they have, at this point, $10,000 minus the 5. That's the equity they have in their house. Okay? And, okay, if that's their only liability, then their equity must be worth $6,100 to get this to balance to $11,100. And so you see their assets equal their liabilities and their equity. It's this side of the balance sheet that funds this side. So this $5,000 helped buy what's over here. And then this is equity that helped initially at one point in time fund your assets. Okay? So now let's look at a retail money market mutual fund. As I said, these were shadow banks from long ago. They still exist. There's still an interesting part of our financial economy, financial institutions. And so here we have their balance sheet. They have assets, they have liabilities, and they have equity. Well, I should be careful. They usually don't have too much in terms of liabilities, but they'll have some. But here's the point. These retail money market mutual funds, they invest in what are called money market instruments. Money market instruments are short-term debt. And so that's what these things own. They own as assets short-term debt that pays an interest rate. Okay, so they lent money. Basically, these money market mutual funds lent money to somebody. And it even could be the federal government. Included in here could be treasury bills, which are bonds that have been sold by the U.S. government, very short term. They earn very low rates of return. They're very low volatility, very little risk. And so there's not a whole lot to analyze in terms of risk and return on these things. They, what they advertise in a return is basically what you're going to get. So that's what these retail money market funds invest in. Okay, so that's their assets. Now, like I said, they may have some liabilities. Let's just assume for now that it's just zero. And they'll have equity. So let's just say there's $1,000 in treasury bills, which are short-term debt, and there's $1,000 in equity. Now, what does that have to do with us? Because remember, I said retail means it's for individuals. Well, you and I can invest in these retail deposits. And what we do is we send our money into these mutual fund complexes. We send our money in. We buy shares worth $1. Each share is worth $1, and it stays $1. And then those shares earn a little bit of interest every day that we get off of this. And so we're getting the interest basically from this debt here, this asset. This asset's generating a little bit of interest. The fund has some expenses, so it's this interest income minus the expenses, and that's what we're going to get as a return here. And so our share prices are going to stay at $1, and we're going to earn a little bit of income, and our account will accumulate. We'll earn more and more shares. We'll get more and more shares over time. So what you see is, look, we're depositing money, and this retail money market fund is telling us, look, we're going to keep your share valued at $1. And you're going to basically invest in this portfolio of assets. And this portfolio of assets is very short-term, low risk. So this side is very short-term and low risk. And then basically this side is very short-term and low risk. Hey, now let's compare this concept to a traditional bank. Now, a traditional bank looks like this. Traditional bank accepts deposits. I'll call them just deposits. It could be demand deposits or savings deposits, or so on. Okay. Let's just say it's $1,000. Okay. And a bank will also have equity, right? And obviously it'll have assets. So it'll have assets, it'll have liabilities, and deposits are a liability to a bank. It's an asset to us. So if this cash over here was deposited in this bank, then it'd be an asset to us. It's a liability to the bank because the bank will have to pay it off eventually. Okay, so here we have deposits, and now a typical asset side of a balance sheet may look like this. It'll have what's called cash, and sometimes, and not sometimes, but we'll call it reserves often. Okay, so cash and reserves are the same thing, and that'll be 10% of this deposit. In other words, every time you deposit $1 in a bank, 10 cents has to be held in the vault or on reserve. That's why this is called cash or reserves. It's cash in their vault or cash that's on reserve at the Federal Reserve, which I'll show you the balance sheet for them in a second. So basically what happens is banks have to keep 10% of their money that gets deposited in the form of cash in a vault. Let's think of it that way for the moment. The rest of the money, the 90%, has to be or should be invested in things like securities and loans because the bank has to make some profit. It's not making very much money in terms of just sitting on cash. There's a huge opportunity cost, and the bank really can't function without some profit without some profit motive. So it invests its excess reserves, so to speak, in securities, and it invests in loans. So let's just say these are the dollar amounts. So our asset side of our bank is $1,800. And then well, obviously this side, the right hand side, needs to be $1,800. We have $1,000 in terms of deposits, but banks also have other borrowings. They borrow they issue debt themselves. Let's just say that's $600, and then let's say $200 in equity, okay, which is often called, in terms of a bank, equity is called its capital, bank capital. There it is. Now, let's look at things for a second here. Now, if you look at a bank, and if a bank is required to hold 10% of its money in reserves, there's a huge opportunity cost, and some bankers will refer to that as a tax. It's effectively a tax, because the more you have to hold in reserves, the less money you're being able to generate. So bankers don't like that so much. Right? It impedes on their profitability. The other thing that banks are required to do is they're required to have a certain amount of capital. And capital is right here. It's capital usually relative to total assets. There's a whole bunch of different ways of calculating it, but one way is to take equity or capital and divide it by total assets. Okay? And so in this case, you can see equity is, let's see, 200, I'll get my calculator out, divided by 1,800, it's about 11.11%. Now, that's one form of looking at capital. You can flip this over and calculate a leverage ratio. And leverage ratio is total assets divided by equity or capital. And that would be 1,800 divided by 200, and that would be a leverage ratio of 9. Now, to talk about this, because leverage goes up and down over the business cycle. As we've talked about before, when the business cycle is on the upswing, people tend to borrow more, and that's effectively how this is going to work here. If there's an upswing, and if you keep this right here at $200, and this side of the balance sheet starts going up, the only way, if you keep this fixed and the 1,800 starts going up, is you got to be borrowing somehow. This borrowing has to be going up. And so you can see when you have more total assets controlled by a little bit of equity, your leverage is going up, and that makes you a bit risky. It's kind of like, you can borrow a lot of money to buy a big house, but the moment you become unemployed, you may not have the cash on hand or the worth to be able to pay off the mortgage over time. It makes you more risky. So what I'm trying to say is the more debt as an individual holds, the riskier they are. The same thing with the bank. The more debt the bank has, the more leveraged up it is, the riskier it is. And then when banks tend to deleverage when the economy starts to head south, they start deleveraging. They get rid of loans, pay off some of their liabilities to try to keep that equity stable. Okay, so that's a traditional banking mechanism. Now, let's look at it in terms of this retail money market fund here. So as I said here, this is effectively like a tax. So banks have reserve requirements. They also have capital requirements. They can't, in other words, flip side of that is they can't be leveraged up too much. So in the 1970s, interest rates started to skyrocket, and there was a lot of regulations on banks that banks couldn't pay high rates of interest. And so banks were kind of getting strangled. The supply of money coming in through deposits was very low, and that means the banks didn't have access to liquidity very much. And one reason they didn't have access to liquidity is because as interest rates went up, and these money market mutual funds were investing in short-term debt that had high rates of return, higher rates of return. So people like you and I put our money in these money market mutual funds. We bought it at $1 per share, but every day it earned, let's say it earned a penny. It's exaggerated, but let's say every day it earned a penny. And so we accumulated interest income. We accumulated more shares over time. And that's how this form of shadow banking came about. It came about because banks were kind of strangled with various regulations. this traditional banking system is expensive. And what it is, we're paying for this because of the liquidity that banks provide. So banks provide liquidity to individuals when there's a problem. So there's a financial crisis, you pull your money out of a bank. Now, it could be the banks run into trouble, right? Because too many people are trying to pull their money out, and this $100 reserves isn't going to satisfy $1,000 worth of deposits. That's where the Federal Reserve comes in. It's the bank of banks. So when this traditional bank starts to have liquidity problems, that's where the Federal Reserve Bank comes in. And I'll show you their balance sheet in a second. Now, these retail money market mutual funds, they're less regulated than traditional banks. And they tend to have not fallen into very much trouble because they tend to buy short-term debt, and it's very low risk, low return. And the other side of the balance sheet is liquid because of this liquidity that's here. So one of the things you got to keep in mind, whether you're an individual or a traditional bank, is if you have to pay off your liabilities somehow quickly, can you liquidate these? Can you liquidate this side of the balance sheet? If not, you're considered illiquid. Well, if a lot of people pull their money out of a retail money market fund very quickly, these things are highly liquid. These can be sold quickly. So this type of organization doesn't have a lot of risk, and it doesn't have a lot of specifically liquidity risk. Okay. Now let's look at the Federal Reserve quickly, and then we'll look at a traditional shadow bank in today's world. Okay, so here's the Fed. The Fed has as a liability reserves. So the reserves that we saw here with a traditional bank, right? We said there it's either cash that's in their vault or cash that's on reserve at the Fed. That's a liability to the Fed. It's an asset to the bank. You don't want to have an asset in two different places. So it's an asset here. It's a liability to the Fed. And let's just say it's $1,000. And those are the reserves. There's also currency. That's a liability of the Fed, money that's floating around in our pockets and cash registers. Okay? Now, Fed also owns securities, and it also may be making loans to banks. Okay? And the Fed's balance sheet will balance. I'm just looking at the main accounts that we're interested in. It'll balance. There'll be in any one of these, in every one of these instances, the Fed, a traditional bank, a retail money market mutual fund, they're going to have lots of accounts on their balance sheet. But we're focusing on the ones that matter for our purposes here. Okay, so that's the Fed now. So what happens is if a traditional bank runs into liquidity problems, what'll happen is the Fed could make a loan. So it'll increase these loans, say $200 and then to $2,000, and then it'll increase its reserves to $2,000, which means it'll put $1,000 in reserves here, extra $1,000 in reserves in this traditional bank. And it can do that with the stroke of a pen or like a click of a mouse and say, look, we're going to increase our loans by 1,000. We're going to increase our reserves to this traditional bank, call it Traditional Bank A, and it's all done with the click of a mouse. Now this bank, through an electronic transfer, has the reserves that it needs to pay off these liabilities if people want to pull their money out of the bank. Okay? So that's why the Fed is called the bank of banks. It's the bank of last resort, so to speak, for the banking system. So if you and I run into a liquidity problem, we run to a bank. And if the bank runs into a liquidity problem, you run to the Fed, and they're the last ones holding everything up, along with the federal government. So the Fed is a quasi-public institution. It was created by Congress after the Great Panic, the financial panic of 1907, 1908, which by the way, was started by two things. It was started by the earthquake in San Francisco that caused havoc because what happened was most of the city was destroyed. Insurance companies had to pay off their liabilities for all that insured property, And so money left the East Coast and basically had to go over to the West Coast. And those were big obstacles back in 1906, 1907. So that started part of a financial crisis. And then the other thing was there was some stock market fraudulent activity going on, and that caused people to be severely concerned about the financial markets and the health of the banking system, because the fraudulent activity that was going on in the stock market had negative effects on various banks. In other words, the people that were committing the frauds were on the boards of banks. And so people lost their confidence in the banks, tried to pull their money out of the banks very, very quickly. So they try to pull their money out of the bank, out. And what it does is it forces the bank to liquidate everything here. But back in 1907, 1908, there was no Fed to back up a traditional bank. So if everybody pulled their money out here, this bank had to liquidate its assets as fast as possible. It's not always easy to liquidate assets very quickly. And so the bank becomes illiquid, and people, when they hear that a bank is illiquid, there's a bank run. They line up and wait to get their money out as fast as possible on demand. And that makes things even worse, and that usually causes other banks to collapse. It was because of that the Federal Reserve, our first central, well, actually our third central bank that we had in this country, and that's a long story. Take financial institutions and markets if you want to learn about the fits and starts of central banks in the United States. But the central bank, the Fed, that started up in 1913 was actually our third attempt at a central bank. The third and last so far. Okay. Now, one more thing I want to do in terms of balance sheets, at least at this point in time, is let's look at traditional shadow banks. And this is kind of cool. So, as I said before, shadow banks have been around for quite a while, but they really started to take hold late 90s, 2000s, early 2000s, and they got a hold in the real estate market is where they got their foothold in. So here we have shadow bank. Okay? And a shadow bank invests in residential mortgages. And I'll explain that in a second. They convert these residential mortgages into residential mortgage-backed securities. Okay? They take in short-term, they issue short-term debt loans to fund this. So where do they get the money to buy all these mortgages? Well, they issue debt, short-term debt. And obviously they have equity, right? But now let's look at this a little carefully. Well, why would the shadow banking system even come into play? Again, the regulatory environment of the banking system is kind of harsh. It makes it less profitable to make money, it makes it harder to make money in a bank. Shadow banks are a way to skirt around that. And so that's how they got into the residential mortgage industry. Now, why would they do that? Well, here's the thing. If you look at a traditional bank, here's what's happened over the years. This is part technology and just part improvements in our economy. So a traditional bank often has a loan portfolio, and they have commercial and industrial loans, C&I loans. They'll have auto loans. They'll have mortgages on houses, and they'll have commercial real estate, for example, loans. They'll have various loans. Now, let's say you're in a small community and, there's a strong housing boom going on. Construction's doing quite well. And you go to your local bank and you need money for a mortgage. Well, if you went there to the bank will say, well, lots of other people have come in before you. We've kind of lent all our money out that we have because we collected deposits from the community. And we took those deposits and we lent them out in commercial, auto, and tons of other mortgages to other people, and even commercial real estate mortgages. We don't have any money for you. And not only that, the Federal Reserve requires us to have a diversified portfolio. We can't put all our money in one particular category. So they turn you away, and you'd have to go to another bank, and the other bank would tell you the same problem, same issue, and you wouldn't be able to get a mortgage. Well, the federal government noticed that a long time ago and allowed organizations to go out and buy mortgages off the bank's books. So a bank may invest in these mortgages, and these mortgages this is money that's tied up in some cases for 30 years. 30 years it's tied up in. And so that's not very good. That's not very liquid. So what the government allowed is various organizations, say like a shadow bank, to buy these mortgages off the books of the bank. So what happens is the mortgages go off, right? And it becomes cash. So they liquidate their mortgages. The shadow bank gives the traditional bank cash, so no more mortgages. It turns it into cash. And then when you walk in the door and you want a mortgage, oh, they got cash to be able to give you the mortgage. They help you, lend you the money. Okay? Shadow banks are facilitating that situation. And so those mortgages end up going on the shadow bank's balance sheet as an asset. Well, the shadow banks take hundreds and thousands of mortgages and packages them. They pool them together and they sell them as bonds, and they're called residential mortgage-backed securities. They're bonds backed by mortgages. Now, for the shadow bank to operate, it needs funding, and so it issues short-term debt, and everything looks great. But here's the problem. This is short-term debt. It's got to be rolled over every 30 days or, very quickly, because they're borrowing for maybe a month, maybe 3 months. But look at residential mortgages and mortgage-backed securities. Like I said, the underlying assets for this can last 30-some years. That's a problem, because what happens if there's a lot of defaults on residential mortgages? Remember the subprime issue that happened in the Great Recession? So there was a whole bunch of defaults in subprime mortgages, kind of high-risk mortgages that were being lent out. And those mortgages are in default and start to default. And then the people that are lending money to this shadow bank are saying, wait a second, we're lending you money, but you may not be able to stay in business because your assets are falling apart. You're getting huge losses over here because the mortgage holders aren't paying you back. Not only that, but this short-term debt is collateralized by these mortgage-backed securities and these mortgages. So what happened was the funding dried up right here. People would not lend money to the shadow banks because their assets were bad, basically. Hence the liquidity crisis. So that short-term funding problem worked its way throughout the entire economy and caused a liquidity problem, literally throughout the economy, which is where the Fed had to come in and inject liquidity into the banking system. What did the Fed do? The Fed basically bought this short-term debt. In other words, funded these shadow banks, which allowed them to continue and operate, gave money to the banks, lent money to the banks like we saw here, and kept the banking system afloat and with just enough liquidity to let us squeak by. So my purpose here is to show you the shadow banking system, right, which is, by the way, this about the same size as our traditional banking system, which is what's discussed in nearly all introductory textbooks. It's the old traditional banking system, which is alive and well. But these shadow banks have basically taken over the market because they're cheaper. It's cheaper to do business. It's less regulated, and as a result, it's more profitable to act as a shadow bank than a traditional bank. So by doing this, I've shown you shadow banks, traditional banks, the Fed, which is the bank of traditional banks, and now by default has become the lender of last resort to shadow banks as a result of the Great Recession problems. And then we saw how retail money market funds are basically a form of a shadow bank. And if you go back to that retail money market fund that we looked at a little bit ago here, right? Remember I said, look, this is short term and low risk, low return, and you can pull your money out at any time here, and your investment here is low risk, low return because you basically indirectly you own this short term debt when you invest in a money market mutual fund. Okay, so there's risk and return and liquidity issues are balanced on this balance sheet because this is short term debt and this is short term. So if you wanted to pull your money out quickly, this retail money market fund can liquidate these short-term securities very, very quickly and pay you off. Now look at the shadow bank. As I said, this is very short term. It runs into the liquidity squeeze that I talked about because this has to get rolled over. And these are long-term assets that can sit on your books for 30 years, and this can sit on your books for 30 days. And you got to keep rolling it over every month and borrowing and reborrowing and borrowing and reborrowing to be able to finance this side of your balance sheet. So remember, this side funds this side in your balance sheet. But there's another issue here, and it's this. This is very short-term, very low risk. But here's the problem. Who would ever want to lend money here to this shadow bank in order for it to buy these long-term, highly risky assets? These are very sensitive to changes in interest rates in the real estate market. Well, this is how the shadow bank does it. The shadow bank, it operates this way, but it overlays on top of this balance sheet. And I don't want to put it near the balance sheet because these things are not technically on the balance sheet. What they do is they invest in interest rate swaps, IRS's interest rate swaps. And what interest rate swaps does is it allows this shadow bank to reduce its interest rate sensitivity. So if interest rates go up or down, it's not going to hurt the value of their business and cause problems. That's what interest rate swaps can do. And then there's the chance that there's going to be defaults in the mortgage in various mortgage products like mortgages and mortgage-backed securities. And so these shadow banks can invest in credit default swaps, which basically says if these things go bad, these credit default swaps will pay off when these things go bad. It's basically insurance. It's almost as though think of these two things as insurance. If interest rates move against you and hurts the balance sheet and the profitability of this shadow bank, the interest rate swap will pay off. And if there is credit default, that means credit, meaning default, credit default. People can't pay off their mortgages. Then these credit default swaps are basically insurance that when this goes bad, this shadow bank is still getting funding. It's getting paid off, which means that it transforms this highly risky and illiquid securities, right? And mortgage is illiquid because it goes for 30 years in some cases. Highly illiquid, highly risky. If you add these two things, interest rate swaps and credit default swaps, you get rid of a lot of the risk. So therefore, you're balancing the risk here with the risk that's over here at this point. And it makes for a viable business model now. The problem was when these shadow banks operated before the Great Recession, they didn't really have enough of these interest rate swaps and credit default swaps. So when this started to tank, they didn't have the credit default swaps to pay off. And not only that, but the credit default swap market was so contaminated that it didn't work the way it should have. And that's a whole other story, but it didn't really work that well. And they weren't really hedging things with interest rate swaps to a big degree. So that's the story of balance sheets, the Fed, traditional banks, shadow banks, and the retail money market mutual funds. Now, what I want to do is talk a little bit about the overall Federal Reserve and the system, and then we're going to get into money multipliers and other aspects of banking that are going to be important later on in this course. Yeah, here we go. So moving right along, the Fed is made up of 12 regional banks across the U.S. in major cities. And there's two that are really important. There's the New York Federal Reserve Bank, and that's important because they do what's called open market operations, which we'll discuss in a few minutes. That's the purchasing and selling of securities that the Fed does to manage the money supply, to increase or decrease the money supply, and in turn change interest rates. So that's what the New York Fed does, because the New York Fed is in the heart of Wall Street. And it's next to the international banks. It's next to other regulators in the city. And so it's central to what's going on. The other key regional bank is the D.C. Bank. So there's the Federal Reserve. That's the headquarters of the Fed, actually. And that's where the FOMC meets, the Federal Open Market Committee, which is made up of 12 voting members, and they're made up of the members from the Board of Governors. And the Board of Governors, by the way, oversees the entire thing. BOG oversees the entire Fed. And then there's a committee underneath the Board of Governors, so to speak, that's the Federal Open Market Committee, 12 voting members. And 7 of those come from the BOG, and then there's 5 presidents that from the regional banks that are also on this. So 7 comes from the BOG, and then 5 are regional bank presidents. Okay. And this committee is, like I said, one of the most powerful committees in the world, and they set reserve requirements. I'll call it RR, but I'd like to call it RR, but I think your textbook uses capital R. So reserve requirements, that's the 10% that I was talking about. If you deposit $10, the bank has to keep $1 on reserve at the bank or at the Federal Reserve. So the FOMC controls the reserve requirements. It sets targets. Sets targets for the Fed funds interest rate, which I'll talk to you about shortly, and then it monitors the money supply. And the overall Fed, so that's the main things that the FOMC does, but the Fed itself monitors the banking system and sets up this mechanism to deal with all the thousands of banks that are throughout the United States. There's about a little over 5,000 banks in the United States that are controlled to some degree by the Federal Reserve. Now, there are state banks and there's national banks. The national banks are underneath the Fed, and there is also state banks. And it's a long, long story that we talk a bit about in financial markets and institutions, but we're not going to talk about it here because, like I said, it's a long story. But the point is, there's both state banks and there's national banks, and those even the state banks have reserve requirements that are set by the Fed. But the state banks are in some degree controlled by the states themselves. So now let's talk about some things I mentioned here. I mentioned, setting the Fed funds target and open market operations. But what exactly am I talking about? Well, remember I told you way back here, I told you, look, a bank has deposits, it's got to keep reserves, and that's the reserve requirement. But what happens if a bank runs short of reserves? It could liquidate some of its securities and liquidate the securities to bring its reserves up to balance. Or it could go to the Fed. You usually wouldn't want to do that under normal circumstances. It could go to the Fed and request reserves. But there's other ways of doing it. There's other ways to get money in a pinch, because these banks there's billions of dollars floating in and out of a bank constantly, and so it's not unusual for a bank to have less reserves than is required, or to have excess reserves for that matter. That's where the Fed funds market comes in. There is a market for loanable funds between the banks, mainly between the banks. So this axis is dollars, it's loanable funds, and this is, I'm going to call it IFF, the interest rate on the Fed funds market. The Fed funds is the market for reserves, basically, and it has a demand curve, and it has a supply curve, and the market sets that equilibrium value, that equilibrium interest rate. And what the Open Market Committee does, the Federal Open Market Committee does, is it sets a target for the interest rate. And if it sets a target that, it wants the interest rate to go down, because the economy looks like it's heading for some bad times, they'll want the interest rate to go down. And the way they do that is they expand the supply of money. So here we have a supply of money, and they can increase the supply of funds in the entire banking system. And so the supply curve moves out, and when it does, interest rates decline. Now they do that through open market operations. They'll purchase securities from the banks. And so remember, we have a bank, and it has securities on its books. What the Fed will do is it'll buy these securities, give the banks fresh cash, and now the bank has liquidity. More liquidity than it had before, and the more liquidity that's in the banking system, the lower interest rates will go. So what will happen is this. You got the Fed, and you got a bank, and so the bank will get cash, slash reserves of, say, let's say it's $500 for these securities, and $500 will come off the bank's books for securities. So there's no change in assets and there's no change in liabilities in total. It's just a swap. You liquidate securities, you get cash. The Federal Reserve now has a security on its books for $500 because this security went over to here. And the Fed issues reserves with a click of a mouse or the writing of the stroke of a pen, $500. And so there you have it. There's more cash now in reserves floating in the banking system as a result of this transaction because the Fed literally created it. This is what some people talk about, how the Fed literally can print money. It's not printing money, it's just electronic transfers. But there was really, literally this money was generated out of thin air in a sense, these reserves. And that's what the Fed can do. And so interest rates come down as the supply of money goes up. As supply of reserves, loanable funds that are in the banking system goes up, interest rates come down. So the Fed sets targeted interest rates, and if it sets an interest rate lower than what it is now, so let's say this is where the interest rate is now, the Fed sets a rate that's lower, it'll conduct open market operations where it'll purchase securities, inject cash into the banking system, and bring rates down. If it wanted to bring rates up, take rates up, it would do open market sales. It would reverse this transaction. It would sell the security to a bank, right? And so this security would disappear. The reserves would disappear. And what we get is an increase in securities on the books of individual banks, and then cash would drop. Cash would drop $500. There would be no change in aggregate of the assets, okay? And then the Fed basically unwinds that transaction. So the Fed can quite easily increase the money supply, decrease the money supply very quickly, and also manage and change interest rates around. Okay? It's all part of the setup of the system. So this open market operations is referred to as one of the traditional tools of monetary policy. The other tool of monetary policy is the reserve. I want to keep on calling it little RR. The other traditional tool is changing that reserve requirements, which usually isn't done in this country. It's done a lot in China, but not in this country. So you can change the amount of reserves, whether or not you have excess or deficient reserves, by changing that 10% reserve requirement. If you increase reserve requirements, that kind of contracts the banking systems. They have to keep more money in reserves, and that'll end up draining liquidity out of the banking system. And if you reduce the reserve requirements, then that's more money that can be lent out into the banking world, in the financial markets. And the third, so you got open market operations, you got changes in reserve requirements, which can change the liquidity that's in the banking system. And the third one is loans. They're sometimes called discount loans. Loans that the Fed makes to various banks. So when a bank runs into trouble and it has liquidity problems, the Fed could literally make a loan. Well, that's not hard to capture here. In fact, I'll forget this. Let's clean up here. We have the Fed. We have a bank. And the Fed will make a loan, which is an asset for the Fed. Let's say it's $100. Right? They will increase reserves for $100. The reserves will end up on the bank's books, and the bank will have a liability, right, or a loan here of $100. So you can see the change on this side equals the change. So you know your balance sheet still balances in both cases. And so loans increase for the Fed. Money gets to these two, or basically the same side of the same two sides of the same transaction. And then there's a liability that matches up between the bank and the Fed. And that will increase reserves. So the Fed lends money to the bank, increases reserves, and if it reverses this transaction, it'll absorb reserves and money out of the banking system. So open market operations can increase or decrease the money supply, changes of reserve requirements, and then discount loans. And they say discount loans is sometimes called through the discount window. Years ago, you'd literally go up to a window to get money. That was a long, long time ago. Now it would be a large department that you would go through to do that. So now what we want to do is this. Let's talk about, how does this open market operation actually work? Because if the Fed, for example, let's say it does $1 billion in open market operations where it buys $1 billion worth of securities from the banks. Okay, but will that inject $1 billion into the banking system under normal circumstances? And if that's the case, $1 billion in our banking system today, it's going to get lost in rounding. Nobody's going to notice it. So how does the Fed actually move the markets? That's where the multiplier process, the money multiplier process, and that concept comes into play. It comes into play under normal circumstances. And so I'll show you how the Fed works under normal circumstances with the money multiplier. Then we'll talk about, where the real multiplier is today because of all of the turmoil that's existed since the Great Recession and has seemed to come back to haunt us again with the coronavirus coming through. And then in the end, we'll talk about non-traditional monetary policy. Get around the fact that the money multiplier is about 1 or less in today's world. Okay, so let's look at open market operations more closely and the money multiplier. So let me clean up what we had here. So in this part of the video, I want to cover how the money multiplier works with a deposit when you or I deposit money in a bank, or when the Fed does an open market operation where it purchases a security from a bank. And basically what you're going to find is you're going to see how money multiplies, flows through the banking system and expands. That's where the multiplier comes in. It's an expansion of money. So let's take a look at how this works. Let's assume you deposit $100 in a bank. And what we're going to do is let's trace it through each bank. So here, we're going to call this First Bank, First National Bank, and the deposit will be right here as a liability to the bank. Okay? And the bank will get reserves or cash of 100. Now, all banks have a profit motive, and if they kept 100% of their money in reserves as reserves, they'd go broke because it's not really working for them. So what they have to do is they're going to have to convert this into securities or loans. And so that's not hard. So notice the balance sheet balances with that deposit. And what's going to happen is let's just assume that the bank makes a loan for $90. And what it's going to do is it's going to reduce cash. So cash will be reversed. Or in other words, reserves will be dropped by 90 and loans will go up by 90. So notice what happens. The net effect of this is that reserves go up by $10 to meet the reserve requirements. We're going to assume that reserve requirements are, capital R is 10% here. And 90% gets loaned out. Okay, and money has to go out. When you make a loan to a customer, the money's going to go to the customer. Now we're going to assume that customer, and this is mainly for bookkeeping purposes, we're going to have another bank, and this customer is going to take this loan and the money that they get, and they're going to put it in the Second National Bank. And it's mainly bookkeeping purposes so that we can keep track of the process. Otherwise, it gets kind of messy trying to use one particular bank here. And so here, what's going to happen is deposits are going to go up by 90. That's associated with this here. So deposits go up by 90. Reserves go up by 90. The balance sheet balances for the next bank. But again, this bank needs to hold just 10% of the 90. It needs to hold $9. And so reserves will drop by $81 and loans will go up by $81. And, an increase of 81 minus 81, this asset side does not change at all. And now we have a loan being made, and we're going to deposit it in a third bank. So whoever gets this loan will deposit it in the Third National Bank. And so their deposits will go up by 81, and their reserves will go up by 81. That balances. And now they have to hold $8.10. So to make some money, they're going to make a loan for $72.90. $72.90. That's 90%. And so on. So there's the process that you see that goes on with a fractional reserve system. If you didn't have fractional reserves, the whole process would stop. There would be no multiplier effect. And I haven't quite really shown you the whole multiplier effect yet, but you're kind of getting the feel for things are starting to multiply out in various banks here. Keep in mind now that how does this relate to economics? Obviously, this is an economic phenomena here, but look, these people are not taking out loans for the fun of it. These people are taking out loans to expand their businesses. Or to consume. So they could be borrowing money, to buy a washer machine, to buy a car, to buy a house. And so consumption and investment are likely to go up because of these loans that are being made. So now let's run a tally as to what happened here. And what I'm going to do is I'm going to write out currency, and I'm going to write out reserves, or what we call cash. Remember, this is cash on reserve. It's cash in a vault of the bank or reserves at the Federal Reserve. So they're basically the same thing, cash/reserves. And then we'll have loans, and then we'll have deposits here. And so if you notice, I've written this out. It's almost like you can draw lines here. In fact, I will draw lines here. These two accounts are the asset side of the balance sheet right here. And then deposits are the only thing that's changing on the right-hand side. So let's keep track of what's going on. Now remember, this is money supply right here. Money supply is currency plus deposits. We're just going to say simply the money supply equals currency plus deposits. And so what's going to happen is your currency is going to drop. Money is going to drop out of circulation when you deposit it in the banking system. It's out of your pocket. It's in the banking system. And then with First National, it ends up as a deposit here. See this deposit? It ends up when we were all said and done, loans of 90, right? There's the loan of 90. And then reserves end up being the net of this is $10. And so I'm writing this reconciliation out so we make sure we balance all along the way. And we are balancing. And so then the Second National Bank, what happens here? Well, loans go up by 90, deposits go up by 90. The net effect on reserves is $9, and then we got $81 in loans. And then we go to the third bank, and this turns out to be $81.72.90, and this is $8.10. And now we're going to assume that this goes on forever. In other words, there's an infinite number of banks, and we make that assumption, the infinite number of banks where this process holds. Now, before we go further, let's look at the assumptions that we've made and underlying this process. The assumption is that first, and we've laid it out explicitly, that there's a 10% reserve requirement, and that banks hold true to that. They don't hold any excess reserves. So these banks are true to their profit motive. They're going to lend all their money out that they can, and they keep just 10% backup for deposits. Okay, so that's that 10% reserve requirement. There's no excess reserves. And we're also going to assume that these people, when they get their money from the loan, that they deposit 100% of that money, so that there's no change in the amount of currency to deposit after this initial effect here. And there's no change in this process here. There's a change right here with currency relative to deposits, But after that effect, nobody's pocketing any money along the way before they make this deposit, the next deposit. Okay, so now what we want to do is we want to figure out, well, what does this total out to be? Sigma. What does the total effect of all of this come out to be? That's what sigma means, total. It comes out to be 100. This comes out to be 900, and this turns out to be 1,000, which is kind of good because you notice it balances. And if everything balanced along the way, it should balance in total. But what we want to do is derive how we got this effect. So basically what we're saying is, look, you deposited $100. That's it. You took some money out of currency, and look what happened. The money supply dropped just by 100 because of this transaction overall. And we could put in a minus 100 here. And then what happened was, look at the money supply process within the banking system. The money supply process in the banking system expanded 10 times the initial deposit that you made. So what we want to do is derive the algebra behind that deposit. And so here's how it works. The change in deposits are going to equal the change in reserves times 1 minus the reserve requirement to the 0 power. So what does that mean? So this is the first bank that we're looking at right here. Okay. This is the first bank is right here, the First National. And the initial change in reserves was $100. That's what we're capturing here. So you want to make sure you realize that this is the initial change in reserves. That was right here. There's the initial change in reserves. Okay? And then if we take 1 minus the reserve requirement of 10% to the 0 power, then this equals $100 change in deposits. Well, yeah, it did. There's the deposits right there, $100 matched. Okay, but that's the first bank. Now we want to see what happens to the second bank, Second National, and that's the initial change in reserves. The same number here, same algebraic expression here, and it's 1 minus the reserve requirement to the first power. Okay, and this will be 100 times 1 minus 0.10 to the 1 power, and that turns out to be 90. Okay, and if we do the same thing for the third bank, it becomes this expression. So this is the third, and we get 100 times 1 minus 0.10 squared. That's 81, and it continues to infinity. Okay. Now that that doesn't help us very much because all I've done is I've taken this process and algebraically expressed it into an equation. Okay, that's what I showed you. It doesn't really help us. But so what we need to do is let's get rid of this infinity sign, because we can keep adding this up, but how do we really know? And that's one of the points I'm doing this math here. How do we really know? It boils down to this. How do I know that the multiplier, and I'm going to call it little m, is 10? How do I know that? Well, that's what I'm trying to solve. So let me boil this down now, summarize this. I'm just rewriting what I just did so it's clean. Okay, so I just rewrote that equation there. Now, like I said, the problem is, how do you get rid of this infinity sign to know that this adds up to 10 times? The multiplier is 10. Well, I'm going to do a trick, and this trick shows up not just in this course, in terms of a money multiplier. There's also a consumption multiplier that's discussed in economics that has an infinity aspect to it. And then there's also, in my investment management course, how to value a stock. And when you value a stock never matures. And so it generates cash flows that go out to infinity. So how do you value a stock when you estimate cash flows out to infinity? You can't really estimate cash flows out to infinity. So how do you deal with that? Not only that, but there's also bonds. There's a few bonds, they're called consols, that never mature. And those bonds generate cash flow all the way out to infinity. So what's the value of those bonds? And so if you take a course in investment management or corporate finance for that matter, you'll realize and find out that the value of any financial asset is the present value of its future cash flows. Well, I'm telling you, the future cash flows go out to infinity, so that's not very helpful. But we can do a math trick here, and the same math trick we do in investments to get rid of this infinity sign to see what actually happens. So here's the trick. We're going to multiply both sides by 1 minus r to the 1 power. So we're going to take this and multiply it by 1 minus r to the 1, that's a 1 right there, power. And then we're going to multiply this whole side by the same thing. So res 1 minus r, that'll make it to the 1 power. And then we're going to multiply this by 1 minus r. And this is 1 minus r squared. And this is cubed, because we're going to take this and multiply it by 1 minus r. And we do that all the way to infinity. Let's assume we do that to infinity. Now you're looking at this, it's like, I just made it messier. You can get rid of the infinity sign, but it's really easy now to get rid of this infinity sign, believe it or not. What I want to do is take this equation and subtract this equation. When I do so, things clean up really quickly. The infinity sign goes away, and we can get closer at an algebraic expression for that multiplier. So it becomes delta D minus delta D 1 minus r to the 1 equals, now let's see, what does this equal? How do I subtract all this mess? So I took this and I subtracted this. That's easy. But how do I deal with this? Well, look what happens. See this term? It matches this term. So cross that out. You see this term? It matches this term. And there's another term here and here that match out, and so on. And when you get all the way to the end out this way, these things are basically zero, these terms, because you're taking it to the 1 minus r, which is 0.10 for r, to the infinity. That basically is zero. So what you're left with is delta res times 1 minus r to the 0. And 1 minus r to the 0, this component right here, this here is 1. It doesn't do anything. So let's collect terms. Delta D 1 minus r equals delta res. Okay, and then what that comes down to be is D, delta D, times r, get rid of the ones net out, this becomes r, equals delta res. Okay, and so now, what does this come out to be? This comes out to be the change in deposits. Don't get lost in this. That means the change in the money supply in the banking system from this initial deposit that we made equals 1 over r times the initial change in reserves. And there's the initial change in reserves. That was your change in deposits in this example. And so what is our change in deposits? Well, it's 1 over 0.10 times 100. And so that equals $1,000. That's exactly what I'm showing you here. So what I've just shown you is the multiplier process. You deposit money, and within the banking system, the money multiplies out through the deposits by tenfold. And then if you want to figure out the overall net effect, is you need to subtract that initial $100 because you took some money out of currency. And when you took the money out of currency, that reduced the money supply. So overall, the money supply increased by $900. 1,000 was within the banking system. 1,000 is now out of the currency, world of currency, and we're left with a change in the money supply of $900. Now, okay, that's good, but let's see how this relates to the Fed. I mean, we haven't really done much here. Let's look at this part. So I just did a deposit, but let's look at how open market operations flow through things. And I'm not going to go through the whole math of things. Once I've shown you this process, it becomes clear as to how an open market operation will work in the money process. Okay, so here's what's going to happen. So let's say we have a bank, and the bank has cash, has deposits, it has securities, it has loans. Okay, and we could put equity in here, or capital, to get this whole thing to balance. 1,600, so that means this has to be 1,600. I'm just making up numbers. So we have a nice consistent bank balance sheet. Now let's say the Fed performs an open market operation and it's going to purchase securities. So here's the Fed's balance sheet. And what it's going to do is it's going to buy securities. Let's say it buys these 500 securities, $500. And so it's going to be an asset on the Fed's books, right? And so this is going to this will go away, and it'll give $500 in cash. Or remember, this is cash/reserves is the term for this account. And so cash reserves go up by $500. Well, how did that happen? Well, the Fed, through the stroke of a pen or the click of a mouse, basically credits the account for this bank $500 and says, look, you now have $500 more in reserves. And the Fed takes that $500 security, and it's now an asset. So the Fed's balance sheet balances, both sides went up. So notice that when the Fed does this, the balance sheet starts to go up. And if you have watched over the past 10 years how the Fed's balance sheet has looked, the Fed's balance sheet has expanded by was about $1 trillion before the Great Recession, and then it went up to about $4 trillion because of operations like this. Then it came down over the 10 years. It dropped down eventually. It kind of actually went up a little after the Great Recession. Then it came back down. And then when the coronavirus hit, it spiked back up as the Fed basically, notice what the Fed did. The Fed pumped in more liquidity into the financial markets, into the banking system. So banks, have their money tied up in securities and loans. And if they need cash because people are withdrawing their money out of the banking system, well, here's the Fed injecting cash into the reserve system and taking a security in the process. So this bank sold to the Fed a security. Okay, so that all works. But notice what happened. The change in reserves went up $500. And when that happens, ooh, look at that. It's that initial change in reserve. This whole process starts coming about. And it kicks off that money multiplier process. The Fed by itself with a small $500 transaction doesn't do very much. But when you multiply it by 10, it does a lot. Not only that, but in this particular circumstance, there was no negative change in currency like we had in this transaction. In our first transaction, remember, in our first transaction, there was this drop in currency because we pulled money out of our pocket, so to speak, and deposited it in the bank. That didn't even happen. There was no change in deposits on this side. If there's no change on deposits, then this $500 is pure excess reserves that can be lent or used in some process. And so in this process here, the Fed buying a security, what it does is it takes bond prices, call them BP, when the Fed demands and buys bonds, it pushes up the price. Just like any good or service, when you increase demand, you increase the price. And so bond prices go up, and what that does is it causes interest rates to go down because there's an inverse relationship between prices and interest rates. So if the Fed buys these bonds and pushes these security prices up, pushing these prices up a bit, and when it pushes these prices up a bit, it earns a slightly lower yield, which kind of makes sense. The more expensive an asset is, the lower the interest rate you're going to get on that, all else being equal. So now this is basically this is open market operations. It's a form of traditional monetary policy. It's been around for quite a while, and we call it traditional. This is what your textbook will, nearly all the basic economics textbooks will go through. But now, since the Great Recession, the Fed has done some non-traditional, non-conventional monetary policy actions. And so how does that relate to this? Well, here's what happened. There are banks in our economy, and there are shadow banks in our economy, and there's other financial institutions in our economy. And typically the way this works under traditional monetary policy, the Fed buys a security from a bank, and the security goes away here, right? And so this is to a bank. But when you do non-traditional monetary policy, as happened in the Great Recession, the problem wasn't just with banks. The problem was with these shadow banks also. So the Fed went out of its normal routine of dealing with banks and actually dealt with shadow banks. And so what it did was it gave cash to shadow banks for their securities, their mortgage-backed securities, for example. So those mortgage-backed securities dropped off 500. And so the Fed, what it did was, one of the motivations was, look, it bought these mortgage-backed securities from these shadow banks. And when it purchased them, it kind of boosted the price of mortgage-backed securities up and lowered interest rates. You want that lower interest rate to spur consumption and investment. And that's really important to recognize. And also kept the mortgage-backed securities in the residential market, the financing of the residential real estate market, afloat a bit by buying this. And then what it did was it kept these shadow banks liquid. And so that's one of the other issues. Remember, this shadow bank funds itself with these short-term deposits. These things are coming due constantly. They're rolling these loans over to finance this long-term mortgage-backed security or mortgages that they've bought. And when you run into a liquidity crisis like we had, then these shadow banks were unable to roll their money over because people who were lending money here, so this shadow bank is borrowing money, well, it's borrowing money. The collateral was these mortgage-backed securities, and people didn't trust these mortgage-backed securities because the people who held mortgages defaulted on them. So that meant these mortgage-backed securities, the cash flow of these mortgage-backed securities was drying up. And that meant if this is drying up, then this is going to ultimately cause the shadow bank to default on its loans here. So it was important that the Fed step in and inject money into the shadow banking system. So now it's the liquidity pressure has dropped, because if it can't roll this over, it's going to have liquidity problems. Well, it's giving these shadow banks cash to pay off their short-term debt, so they don't have to roll it over. So not only that, but the Fed also went and did these transactions with other financial institutions. So that was part of several different types of non-conventional monetary policy actions that took place. The others are not really our concern for this course. Again, if you take a course in financial markets and institutions, we go into those other actions, those other non-conventional monetary policy actions and tools more extensively. Now, I want to put this together graphically in something that's kind of familiar and show you how interest rates work in a graph. So let's graphically look at what we've done. So we have a quantity of, let's call it the quantity of loanable funds on this axis, a Q, quantity. And here we're going to have the price of money, and I'll just call it I. It's either I or R, depending on which textbook you're doing, but just call that an interest rate. And then what we're going to do is we're going to have this money demand line. So this is the demand for money. Let's look at that for 1 second here. This is what you and I demand to hold money. And so remember, money is currency plus deposits. So that's what we're talking about. What causes us to hold currency and deposits? Well, first off, before we actually address that, why is the slope down? Well, you should know that already. You should be able to come to that conclusion. There's an opportunity cost associated with holding money. When interest rates are high, the quantity of money that's demanded is going to be low. You're moving in this direction because you can earn that amount of money somewhere else in the economy, buying bonds, for example. When interest rates are high and you hold currency, you're losing out on the opportunity cost of money. And the same thing with deposits, because you're earning basically no interest in a checking deposit. And when interest rates are really low, like they are in today's world, then the demand, you're way down here on the demand curve. In fact, we're really down, touching the bottom now. It's touching this x-axis. Interest rates are so low. Okay, so that gives you the reason for the downward slope. Now, there's other reasons for holding money, for demanding money, and that has to do with, for example, income. So when your income goes up, all else being equal, your money demand will go up also. So these are shifters because we're not changing interest rates now. In order to develop the slope, I changed interest rates. Here I'm telling you income goes up. That's going to shift this demand for money up. If income goes down, like in a recession, then this is going to go down. So that's how money demand goes up or down. And there's also its income, and related to income is transactions demand. So you hold money in your checking account so you can write checks. You hold money in your pocket so you can do transactions. And so the more transactions you do, the more money you're going to want to hold. That would increase your demand for money, or it would decrease it if your transactions demand fell. These are the primary aspects of money demand for our purposes. There's others, like, for example, some people hold money for portfolio effects. So money has very low risk compared to stocks and bonds. So you want to hold a little bit of cash, you want to hold some stocks, you want to hold some bonds, so that there's portfolio effects and diversification. Let's not worry about that here. Now, where we want to go is we want to look at the money supply, because we've been talking about the money supply for most of this chapter. So here's the money supply. We usually make the money supply curve a vertical line, meaning this is what the Fed is setting the money supply to be, and we don't think of it as being related to the interest rate. So it's just a vertical line. It's not like this where the Fed increases because of interest rates changing, the money supply goes up. We just keep it fixed. Here is the money supply that the Fed has set based on its expectations of where the economy is going. So it's just a pure vertical line. So now look what happens when we deposit money here in the banking system, or there's an open market operation and the money supply increases. The money supply shoots out this way, M1 or M2, whatever definition. You have a new money supply, and interest rates go from here down because of that deposit or that open market operation purchase. And the same thing would happen in reverse if we withdrew money from the banking system, or there was a sale. The Fed sold securities from its portfolio and the banks bought it. Then money supply would contract and interest rates would go up as a result of that. So a subtle thing that comes out of this is you might ask, well, we've talked about the money supply a lot in this chapter, and the Fed certainly monitors it, tracks it, defines it. But what does the Fed actually do in reality? How does it manage the economy? Well, it turns out that it keeps an eye on money supply for sure. But the thing is, money supply, as we said before, jumps around a bit because of the sweep accounts between M1, M2, so it's kind of hard to define. So money supply jumps around, and it also turns out that money demand jumps around also. And money demand jumps around, and so it's kind of hard to say, look, let's keep our eye on and control the money supply, and that's how we're going to get the economy growing like this. If we get the money supply growing like this, then everything would be all nice and smooth. Well, the problem is the money supply doesn't grow nice and smoothly. It jumps around, and money demand jumps around. So what does the Fed do? I mean, it has to come out and tell the public in the business world what it's trying to do. And it can't really tell people, look, we're going to manage the money supply, because it's a little erratic. So what the Fed does is it says this. It says, look, we're going to set a target for interest rates. We want interest rates to be in a certain area. And they'll do whatever it takes to keep those interest rates in that target range. So the money supply may increase, and so the Fed will do open market operations to contract this money supply to get it back so that interest rates stay in a tunnel, so to speak, in a range. And that's what they do. The Fed says, look, we're going to set interest rates, target interest rates to be in a certain range, and whenever interest rates start to move to the top of the range, they perform actions to get the interest rate back in the middle of the range. And that way, people look at the economy as like, oh yeah, the economy is stable. And that's very important that people view the economy as being stable, because they see interest rates are stable. And so when you go and you borrow money for a loan, get a loan, or you get a mortgage, you're looking at that nice stable rate, interest rate, and you get some comfort and you get some confidence in that things are going smoothly. You don't want to, nobody goes and gets a mortgage and says, I wonder what the money supply is doing in trying to determine whether or not they get a mortgage. Nobody cares about the money supply underneath it from that perspective. People worry about the interest rate because that's the price of money. And if you have a price of money stable, forget about what's going on underneath this. It's important to know from an economic perspective what's going on here, but the general public just needs to know, hey, there's a stable interest rate out there. So I want to wrap up this video by going to reality now. Let's check to see what we've done. Kind of makes sense. Can we knit together the way the world looks today based on what we've learned so far in this video? So here I have Federal Reserve economic data from the Federal Reserve St. Louis. Remember, I told you there's 12 Federal Reserve regional banks. They're responsible for each region's monitoring each region's economic activity. They got an army of analysts in each one of these banks. Federal Reserve St. Louis happens to be one of the banks that collects a ton of data and has this FRED information. We've seen it before in this class. So what I've done is I've put together what's called a Money Multiplier dashboard for myself so that it's easy for me to bring this up when I teach my various classes. So what we want to do here is let's take a look at what the actual money multiplier is today and the components and see what we can learn. First off, let's go to the very first widget here, the very first graph on the left here, and it's currency in circulation. That's the C part of money supply, divided by total checkable deposits, like M1, checkable deposits. And it's the ratio. And let's call that ratio C over D. So C over D, that's checkable. That's currency to checkable deposits. Now, if you look closely at the graph here, it's 0.63 today. And what do we see here? Wow, we see a dramatic shift recently, and that's the coronavirus. And that's because deposits have shot up. So the Fed has injected a ton of liquidity into the banking system. And so people's bank accounts and banks' accounts have gone up dramatically. And we can see that come down here. And here's just total checkable deposits in billions. And see here, you see it moving along, and there it shoots up dramatically the past 2 months, right here. And then currency in circulation, look at it, exponentially growing over all these years. This is going way back, growing all these years. And you can see currency in circulation. Look at that bump up in 2008, 2009 in the Great Recession as the Fed pumps liquidity into the market. And now look, you can see an upward trajectory right here in currency in circulation as people are holding currency, in part, because they need it, and there's possibly a liquidity crisis, so people are holding cash, and especially when you don't have a job. Don't want that. And so here, the currency to deposit ratio has dropped. So keep that in mind. Now let's look at excess reserves to total checkable deposits. And we'll label this fraction little e to D. Okay, and little e to D, if you look closely, that's about 1.0 right now. You can see right about 1.0. So you can learn a lot from this graph in conjunction with, let's come down here to excess reserves. So let's first look at this graph. This is just plain old excess reserves in millions of dollars. And the first thing you notice is, look down here. Banks had almost no excess reserves before the Great Recession. And that's the profit motive. Banks lend everything out nearly as much as they can. There was some money here that was excess reserves, but it's so small it's getting blended in with the x-axis. The only difference is, the only little blip that we have is, look carefully. There's 9/11 right there, where the Fed pumped in a ton of liquidity into the banking system to make sure we got through the cleanup of 9/11 and the recession that was occurring at the time. So, Great Recession comes about, the Fed pumps in trillions of dollars of money into the banking system through non-conventional monetary policy. It bought up lots of securities, and it did so in phases. And those phases are called Quantitative Easing 1, 2, and 3. And you can kind of see those phases 1, 2, and 3, where the Fed bought a whole bunch of securities. And as they bought the securities, excess reserves, money that banks held, this is reserves, cash basically, reserves that banks held that they did not lend because the economy was in a recession and slowing. And even if it wasn't in a recession and slowing, the banks and the economy just can't process that much in loans. The loans wouldn't expand that quickly in our economy. So we had a lot of excess reserves. But we want to calculate things in terms of reserves relative to deposits. Hence, we had currency in terms of total checkable deposits. We have excess reserves in total as a function of total checkable deposits. And you'll see why in a second. Okay, so that's 1.0. And so this is insightful. You can see what's going on here. Now, what I want to do is I want to flip over to pencil and paper and look at what the multiplier is today. I've been telling you, it was recently 1, then with the coronavirus, it's back down below 1. And let's actually see if we could compute it. So here we have the information I collected off of Fred, and I want to develop M. It turns out with a lot of algebra, and I'm not going to go through it in this course, but the multiplier, when you have excess reserves, remember we assumed in the process we did theoretically there was no excess reserves, and then we said that, look, nobody holds money, nobody pockets any money when they take a loan out and they deposit 100% of the money. So we made those assumptions. Now let's look at what the actual multiplier is, and it turns out the multiplier is this. So we have a currency to deposit ratio that we need to reflect the fact that, people pocket currency along the way, and that changes. So we have currency to deposit. We also have excess reserves to deposits. We have the reserve requirement, which is, by the way, consistent with the dividing everything by D. And so that's reserves to deposits. And then we have the currency to deposit ratio. So if we plug these numbers in, we have 1 plus 0.63 divided by 1.0 plus 0.10 plus 0.63. That equals about 0.94. So the multiplier now is less than 1. It's kind of like a divisor. It's not a multiplier anymore. And so there we have it. The multiplier in reality is not expanding that much, which is kind of good. And I'll tell you why it's kind of good, because if the multiplier got really large and we expanded things out and the Fed expanded things like it did and did the purchasing, we would have a way larger increase in the money supply than we already do. I mean, we have a big jump. We saw that, the big jump in the money supply, but it would have gotten even bigger. And it's a good thing it didn't get too big. And so the multiplier now is kind of small. So the Fed knows and realizes that multiplier is small, and that's one reason why it's done non-conventional quantitative easings, monetary policy actions to try to bypass that. So there we have it. We can match up reality with the theory that we've covered in class.